Capital Protection Oriented Schemes. So what are CPOS or Capital Protection Oriented Schemes? As the name says, these schemes try to protect the capital. And let us see in detail. As per SEBI's definition, the scheme should be a closed-end scheme and AMCs should not repurchase units before the end of maturity period. And as per the SEBI definition goes, to protect the capital invested through suitable orientation of its portfolio structure. And see the word oriented towards protection of capital and not with guaranteed returns. So what does it mean? It means that even though the name says that capital protection oriented scheme, it nowhere guarantees the capital. The portfolio is structured in a way that at maturity at least capital will be recovered. But anyhow we have some risk associated with it. Let us see one by one. Here the portfolio is structured to get the principal back irrespective of the market movement. Let us understand this statement with an example. Let us assume the term of the scheme as 1 year. Let us also assume investment as rupees 100, and let us also assume that there is a government security offering 10% yield for 1 year. So the fund manager can invest rupees 91 in government security, which shall become rupees 100 after 1 year at 10% yield. So what is the remaining part? The remaining is rupees 9, which the fund manager can very well invest in equity. So let us see 4 different scenarios. Let us assume that equity grows at the rate of 10%. So after 1 year, the government security will become 100 and the equity component will become 9.9. So the total maturity amount will be 109.9. Suppose if the equity component gives only 0% return, and again the government security will give you 100 after 1 year, whereas equity will remain same, that is at rupees 9. So the total maturity shall be rupees 109. Suppose if we assume equity to deliver minus 50% return. In this scenario, again the government security will deliver rupees 100 after 1 year, whereas equity will deliver or will become half of it. That is, the fund manager would have invested rupees 9 and at 50% negative return, it will become 4.5. So what is the total maturity amount? 100 plus 4.5, that is 104.5. Suppose if the equity return stands at minus 100% return, that is the entire equity amount becomes 0. Even in such a scenario, the government security shall deliver rupees 100 after 1 year and equity will become 0. So the total maturity amount would be 100. So in all probable cases, the maturity amount becomes 100. So our capital is protected. So this is the idea behind this scheme. This is how the portfolio is structured. However, we have some limitation to it. We shall see that in the coming video. In the earlier video, we have assumed that CPOS invest in government securities. However, in reality, the fund manager may invest in corporate debentures also. In such a case, the portfolio shall be subjected to credit risk or default risk. That is, the issuers may not repay the principal or they may not pay the interest in a timely manner. So this will affect the capital protection. And also, the coupon which the fund manager receives from the debt portfolio is subjected to reinvestment risk. So what is reinvestment risk? This is nothing but the fund manager might have invested in a higher coupon paying bonds. Over a period of time, the market interest rates might have come down. In such a scenario, the coupons when reinvested will fetch a lesser yield. And also we should understand that these schemes are essentially closed-end in nature. That is, after the NFO, these schemes shall be listed in stock market. So this poses a liquidity risk. That is, if the investor wants to redeem units, he should sell units through exchange platform. So if buyers are not available, then it becomes a difficult issue. It becomes a very difficult problem for the investor to redeem units or to sell units. These are the features of or the limitations of capital protection oriented schemes. And remember, the proposed portfolio structure indicated in the offer document must be rated by a SEBI registered credit rating agency. So these are the things about capital protection oriented schemes.